Good morning traders. I am Eric from Alpha Market Meridian. Let me cut straight to it. The British pound is currently trading at 1.3594 against the US dollar, and if you are looking at this price action and thinking it feels calm, you are reading the tape wrong. Right now, at this very hour on May 4th, 2026, cable is sitting on a razor's edge. The Bank of England held rates at 3.75% just days ago in an 8-to-1 vote, but the dissent wasn't dovish, it was hawkish. Chief economist Hugh Pill voted for a hike. And yet, institutional traders just pushed their net short positions against the pound to negative 60,600 contracts. That is a ticking bomb. We have professional money structurally bearish, and a central bank explicitly warning about energy-driven inflation. I'm going to show you the exact price levels where this tension resolves, and I'll give you 3 precise trade strategies you can deploy today. Regardless of your risk appetite, we come to a market conclusion first. Here is my definitive read. As you look at the hourly chart, pound sterling to US dollar is trapped in an active bullish correction against a broader macro descending channel. The short-term trend is constructive as long as price holds above 1.3550. That is the line in the sand. Above 1.3550, we are hunting liquidity above 1.3650, with Scotia calling for 1.38. Below 1.3550, we flush toward 1.3473, and if that capitulation low breaks, you are looking at 1.3380 and potentially 1.3150. In plain English, bulls are defending higher lows for now, but the structure is fragile, and the smart money fade is hanging over this market like a storm cloud. Let's take technical deep dive on this pair. Pull your attention to the 60-minute time frame because the structure here is textbook. As you can see, the pair pivoted aggressively off the 1.3473 handle in late April, launching an impulsive markup that carried through 1.3516, 1.3537, and eventually slammed into 1.3559 with institutional-grade volume. The upper Bollinger Band flared violently during that move, confirming a genuine expansion in volatility. But look at what happened next. Just as the markup peaked near 1.3645, a bearish engulfing candle printed with a long upper wick. That was the signal. The pair has since entered a distribution phase characterized by lower highs, specifically a failure at 1.3623, and we are now actively retesting the 1.3580 horizontal pivot. This is critical. That level represents the 50% Fibonacci retracement of the move from 1.3473 to 1.3645, and it is also a classic support-resistance flip zone. If you look at the moving averages, the 20-period exponential moving average at 1.3544 and the 40-period at 1.3528 are both sloping upward, providing an active dynamic bid beneath price. This is textbook bull flag anatomy, but the flag is being held together by a very thin thread. Now, zoom out to the daily chart. You will immediately notice that pound sterling to US dollar has cleared the 61.8% Fibonacci retracement of the 1.3159 to 1.3870 leg at 1.3600, and for 3 consecutive weeks, this level capped every rally attempt. Closing above 1.3600 was the structural breakout signal. The MACD on the daily is printing positive histogram bars, suggesting momentum is technically with the bulls. However, the pair is now consolidating at the resistance line of a macro-level descending channel that extends back to the start of the year. This is where structure becomes dangerous. This is also where you need to note, RSI on the daily chart is reading near 59, not overbought, but losing upward velocity. Stochastic is curling down. A daily close below 1.3550 shifts the entire structure to neutral in the short term. Below 1.3473, the bullish thesis is invalidated entirely. Key resistance sits at 1.3650 as the immediate ceiling, then 1.3720, and if momentum accelerates, 1.3870 as the 2026 high-week close zone. Support is 1.3550 first, 1.3473 second, and 1.3430 as the 25-day moving average. Below that, The structure degrades rapidly toward 1.3150. And fundamental dive also need to be atched carefully. Now let me tell you why this technical tension exists, because there are massive fundamental forces colliding right now. First, the Bank of England delivered what analysts are calling an active hold on May 1st. Governor Andrew Bailey held a press conference where he explicitly stated that a prolonged spike in energy prices could force the bank to raise rates. He said, and I quote, "It would be a mistake to wait." This was the single most consequential central bank statement for sterling this week. The UK services PMI also printed at 53.7, a significant 6.5-point jump that signals the domestic economy is gaining traction. National inflation has also risen to 3.3%, up from 3% in February, and the bank's latest report warns that a bigger energy price shock could push inflation much higher, with energy import costs specifically cited as the transmission mechanism. This hawkish regime shift is what propelled cable through 1.3600, a level that served as a 3-week resistance ceiling and the 61.8% Fibonacci retracement level. The catalyst stack was layered. The 8-to-1 Bow vote with one dissenter demanding a hike, combined with US Q1 GDP coming in at 2% annualized versus the 2.3% consensus. That was a miss that cracked the US exceptionalism trade. Add the fact that Japan's Ministry of Finance executed a suspected second-day intervention to defend the yen, and the dollar index collapsed from 99.30 toward 98.00. When the dollar sneezes, cable catches a cold. But this time it caught a bid. Combined dollar weakness and the widening policy gap is what fueled the 1.3645 intraday high. Let me bring in the linkage analysis here. Euro to US dollar is also testing 1.1755 on the same dollar weakness, but the divergence is critical. The European Central Bank is still priced for a June hike around 90%, but the policy gap between the ECB and the BO is narrowing in sterling's favor. Pound sterling to US dollar is outperforming euro to US dollar in relative terms because the BO's rate path is now more aggressively priced. Scotiabank explicitly notes that UK-US yield differentials remain near multi-year highs, which provides fundamental upside for sterling. The dollar index itself is expected to remain in a 98 to 100 range this week, but that range depends entirely on whether the Fed's hawkish minority holds. DXY is currently at 98.20, down from 99.30, with critical support at 98. If that breaks, the entire G10 complex reprices, and cable has a clear runway to 1.38. Beyond currencies, crude oil remains trapped in the $80 to $90 range due to Strait of Hormuz disruptions and ongoing Iran tensions. Any fresh escalation in the Middle East pushes oil higher, which paradoxically supports the pound in a perverse twist. Higher energy costs increase the probability of BO rate hikes to combat imported inflation. The Bank of England has explicitly modeled scenarios where rising energy forces its hand. This ties directly to gold, which is holding above $4,600. Gold's bid reflects both safe haven premium and inflation hedging, and both narratives support the hawkish central bank stance that favor sterling. Now, here is where the tension comes in. Despite all this hawkish institutional signaling, CFTC commitment of traders' data reveals that net short positioning in British pound futures has surged to negative 60,600 contracts, up from negative 52,000 previously. This 16.5% increase in short exposure comes from a combination of rising gross shorts and trimmed longs across both asset managers and large speculators. As you know, when the smart money is fading a move, the risk of a violent stop hunt or squeeze is dramatically elevated. Notably, retail sentiment mirrors this, with 69% of retail traders also positioned net short. When both retail and institutional money lean in the same direction against a hawkish central bank that is threatening rate hikes, the setup is asymmetric. A break above 1.3650 could ignite a short squeeze of significant magnitude. But if the pair fails to hold support, the bearish positioning will be vindicated, and the downside acceleration could be brutal. Now coming to CTA trading opportunities OF British Pound and US dollars pair to now I'm going to give you 3 strategies with exact triggers, targets, and invalidation points. These are designed for different risk temperaments. Firstly, Let's see a conservative setup. The conservative setup waits for structural confirmation. You do not enter blind. Here is the trigger. A 4-hour candle close firmly above 1.3600 with a body that engulfs the prior candle. If that prints, you know buyers have absorbed the current supply zone. Your stop loss goes at 1.3565, which sits beneath the 20-period EMA on the hourly chart. The logic is simple. If price retraces back below the 50% Fibonacci retracement and the moving average simultaneously, the breakout has failed. Target 1 is 1.3650, the immediate resistance ceiling that capped last week's rally. Target 2 is 1.3720, the 78.6% Fibonacci extension. The risk to reward on this trade is approximately 2 to 1. Invalidation. A 4-hour close below 1.3545 voids the setup entirely and calls for a pause in any long bias. Next, standard setup. The standard setup exploits the bull flag retest that is forming right now. If you look at the 60-minute chart in real time, price is hovering around 1.3580. This is where you get surgical. Your entry trigger is a bounce off 1.3555, confirmed by a bullish engulfing candle on the 15-minute chart. The stop loss is tight at 1.3535, just beneath the 40-period EMA and the structural low of the flag channel. Target 1 is 1.3625, capturing the move back to the distribution high before breakout. Target 2 is 1.3685, which represents the March 2026 high week close zone. Once target 1 hits, move your stop to break-even and let the position run. Risk to reward is approximately 2.5 to 1. Invalidation. A break below 1.3535 on a closing basis shifts the intraday structure to neutral and signals that sellers cap this move. The third one is aggressive setup. This setup is for professional risk takers seeking to capitalize on the crowded short positioning. The approach is a momentum continuation play. Your trigger. A 15-minute close above 1.3615 with RSI on the 15-minute breaking above 60 upon the breakout. Stop loss sits at 1.3585, an extremely tight placement beneath the breakout candle's low. Target is 1.3700, a psychological whole number. That aligns with the prior supply zone above the 1.3650 ceiling. If momentum is genuine, this trade captures the squeeze. The risk to reward is approximately 3 to 1. Warning: this is speculative. A fake out here will stop you out instantly. Only take this trade on elevated volume that confirms institutional participation. Specifically watch for a volume spike exceeding 1.5 times the average on the breakout candle. If you see that, the smart money shorts are covering, and you ride their coattails. If volume fades, stand aside. But always remember, no matter which setup resonates with your style, let me be absolutely clear. Never risk more than 1 to 2% of your total capital on any single trade. This is not a rule for beginners. This is the rule that keeps professionals alive. If you trade a $10,000 account, your risk on one trade should be $100 to $200, period. Before any trade, calculate your position size based on your stop loss distance so that the dollar loss equals your predetermined risk limit. On Monday, we have UK construction PMI releasing, and later this week, ISM services data and Fed Governor Stephen Moran speaks. These are high-impact events. Holding open positions through surprise data prints is how accounts get blown. If you are not comfortable with gap risk, close or reduce exposure ahead of the news. A stop loss is not a suggestion. It is the oxygen mask that keeps you breathing when the market tries to suffocate you. Set it immediately. Upon entry and never, ever widen it. The moment you move a stop to give a losing trade more room, you have abandoned your strategy and are now gambling. Trading is a probability game. Your edge is not in one trade. It is in executing 1,000 trades with discipline. Here is where we stand. Pound sterling to US dollar at 1.3594 is in a bullish to neutral short-term technical posture, fighting the gravitational pull of an institutional net short position worth negative 60,600 contracts. The Bank of England has opened the door to a summer rate hike. The US dollar is structurally weakening toward 98 on DXY, and Scotiabank sees a path to 1.38. The one level that decides everything this week is 1.3550. Above it, you buy dips. Below it, you step aside or flip short. Tomorrow's focal point is UK construction PMI and any further escalation or de-escalation in Iran peace negotiations, which will directly move crude oil and by extension, both inflation expectations and the pound's rate path. I want you to tell me in the comments, where do you draw your own line in the sand for cable this week? Is it 1.3550, 1.3473, or do you see a different level entirely? Drop your price below. If this breakdown gave you a clear framework for your week, smash that like button, subscribe, and ring the notification bell. Every single day I cover 8 assets across currencies, commodities, and crypto. You don't want to miss a session. I'll see you back here tomorrow. Trade smart, protect your capital, and stay disciplined.